Hi, I'm Tom Graffeo with Dove Investment Research and Management. I thought I'd take a few minutes today and go over our fourth quarter economic outlook for 2017. And today I think is a story that you're going to like about some good news, some good things that are happening out there, some opportunities to look at, and also how we're going to take advantage of that for our clients' portfolios and our thinking going into the fourth quarter of what's been an amazing year in 2017 already. So the thing to remember about economics in general is that so much of the economy is driven by consumers. 69% of the economy is driven by consumption, or the consumption that you and I and all the other consumers out there drive. Government does account for about 17% of consumer spending, but that's really not the big part of the economic story going forward. And investments without housing being included is about 12%, so people investing and doing different things and building new things. So the story of the future, and it has been for a while, is certainly about consumption. And people are willing to consume more when they feel more excited about the economy, when they feel more excited about their finances, when they have a more secure job and things change. And I think what the following slides are really going to show you is that's happening in America today, and really been a good focus that's happening in America. One of the things that's also interesting is that we might have more room to grow even still. So consumption's a big part of the equation. This is real GDP. GDP is gross domestic product. How much all of us produce and what's the total amount of all the United States production. So you can see over time it's been very, very high, very, very low. 2010, you can always see those, you can find 2010 or 8 very easily. It's always a downward trend. But the long-term average is about 2.8%. You can see here that we're actually a little bit below average. So there's still room for economic growth, even with the advent of the technology like the internet and different things that's really helped production and helped people overall. So there's still room to grow GDP, which is exciting because that means as the economy improves even further, GDP will grow more, and all the numbers we're going to see here in the following slides are only going to get better with good potential. Now, one of the reasons consumption is driven well is due to unemployment. Unemployment is a key factor. If you, as the old saying goes, when your neighbor's unemployed, it's a recession. When you're unemployed, it's a depression, right? Well, there's a lot less depression around because more people have jobs and more people are feeling comfortable. So you can see the unemployment rate is this top chart here. And you can see back in the 80s under the initial Reagan administration, it was very high. And then you can see also here in 2009, it was also very high, 10%, the two peaks that are really easy. But you can also see since 2009, there's been a steady decline in unemployment rate. And actually today, the average unemployment, this is an important distinction, average unemployment is 4.4%. I'm going to break that down a little bit for you here going forward. But the other thing to notice is the lighter line, the blue line on the bottom, which is wage growth. And what we're seeing here is that wages have popped up a little bit since 2010, but they really haven't gone up as much as we might have thought, with more and more people working and more unemployment going away and more people having jobs. You would have thought there would be more demand for people, so more wage price growth. We haven't seen that yet, but let me explain why maybe a little bit. This chart is interesting because it breaks down not the averages, but specifics. And specifically, education level. If you have less than a high school degree, unemployment in 2017, in August of 2017, unemployment is actually 6%. You can see back during the recession in 2010, the Great Recession, it got as high as 16%, and it's been steadily declining, but it's actually been declining faster than all the other areas. If you have high school and no college, it peaked here and it's come down here and it's about 5.1%. And then finally, some college, 3.8% unemployment, but here's a big deal. If you have a college degree or better, the unemployment rate in America for a college graduate is only 2.4%. So remember that though the average might be 4.4%, for the educated people out there, for people who have a college degree, unemployment rate is actually very low at 2.4%. So education really matters. Not only for getting a job or keeping a job, but also how much you get paid when you have that education. If you are a high school graduate over 18 years old, and you're out in the workforce, an average salary might be as $35,000 a year, $35,615. With a bachelor degree, that climbs to $65,000. Not quite double, but very nearly double that amount. And if you have an advanced degree, that climbs to $92,000, nearly 3 times, or just certainly more than double the amount. So we go from $35,000 to $65,000 to $92,000. What that means is education matters, and for the educated folks out there that have a college degree, their unemployment rate is exceedingly low, there's demand for them, and they're getting paid much, much more. So that's a good part of the economy, because those are the people who are typically buying the bigger houses, buying the better cars, doing different things, and really growing the economy and spending the money. Also, inflation and interest rates. Core component, right? Inflation and interest rates. Now, to a large degree, the Federal Reserve's job is to link the two of them and to use one as a predictor of the other. But you can see that interest rates since 1981 have been steadily declining, and particularly since 2010 have been declining. And the 10-year note is running at about 2.12%. Really low. Now, there is a reason, okay? If you're the federal government, you control interest rates, which means how much you have to pay to borrow money. And you have to finance about $20 trillion worth of debt. You want to keep interest rates low. You have a distinct motivation to keep interest rates at a really low rate. But you can certainly see that here in the case. Now, every indication is going forward, the Fed is expected to start raising interest rates. It's one of those things that they can see. They can't really see inflation happening, but they can smell it, and they know it should be happening. So kind of in a Greenspan way, back in the 80s, Greenspan did this. They kind of raised interest rates in anticipation of it, and we're going to start seeing that. So that's going to start affecting a few things potentially. But again, they want to be slow to raise interest rates because they have $20 trillion that they keep financing in debt. Consumer Price Index, linked to inflation to a large degree. But you can see also that Consumer Price Index, headline CPI, and core CPI, these are 1.7%, 1.1% for food. Energy is the highest component of the overall Consumer Price Index, meaning how much things are increasing in price. So these are historically very, very low numbers, which is really good for the consumers. Again, so we're not having to spend more money. We're making a little bit more money. More people have a job, and we are not creating all that rapid inflation that normally accompanies with that yet. So these are good indicators across the board. Now, very busy chart, I acknowledge, but I'm going to break down some of these and have you take a look at it. So, why do people feel confident in their economy? Why do they feel in their personal economy, right? Why are people feeling good? First thing, the average price for existing homes, single-family homes, certainly 2005 it peaked, dropped down through 2010, back up again, and past the highest point of 2005. That's interesting, right? So prices of homes have gone back to all-time highs. Interest rates have been driving part of that, because interest rates here, you can see, since 1996 have declined as well to very low numbers. That will drive, because more people have jobs, more consumerism, more stuff, low interest rates, and that's driving the affordability, right? Low interest rates drive affordability of making home more affordable, driving up prices. And the counterpoint to all this is that lending standards have gotten higher. So that's the government saying, hey, we saw what happened in 2010. We don't want that to happen again. So we're going to make it a little bit higher. FICO scores have to be lifted up and be a little bit higher to actually lend the money that everyone's looking at. But overall, again, a very positive note. Okay, maybe a little scary in some ways, but affordability and interest rates are hanging in there. If interest rates dramatically start going up, yeah, we're going to start thinking about real estate and what impact that might have on individual homes and single-family homes, and how that might impact people's overall net worth. And so what I want to show you here is overall net worth. family home net worth. And you can see that since 1990, the net worth, 2007, everyone's net worth came down when housing prices imploded, but gone back up. And you can see that seasonally adjusted individual home net worth have really been climbing quite a bit and quite steadily. Now, you have two things happening. Sure, we saw on the last slide that individual home prices have been going up, so that's raising net worth. Debt's coming down. And you'll also see the stock market's gone up, right? The stock market's gone up a lot. We're going to talk about that here in a few slides. Between those two things, when your house value goes up, your 401k goes up, your investment accounts go up, your accounts with Dove maybe go up. Yes, your net worth goes up and you feel pretty good about life. And there's no guarantee they're always going to go up, right? Things go up and down, but right now things are looking pretty good. Consumer confidence, higher than average. And you can see the consumer sentiment, again, going back to the core things. People have a job, they're getting paid decent money, their house is up in value, their accounts are up in value, everything's kind of feeling good. So yes, overall, consumer sentiment is maybe not at an all-time high like in the tech bubble era, but it's certainly improving and getting better. Now, here's the long-term trend of the stock market, okay? This is capitalism, and capitalism works. It's imperfect. It's been said, well said, I think by others better than I. Capitalism is imperfect, but it's the best thing we have at this point, right? There's no better deal out there, or better thing out there. But you can see from the 30s, there's been this long, kind of great upwards ramp. Okay, there was a little bit of a tech boom sell-off here and the global financial crisis, but we're back up again long term. I'm going to break this down for you to take a deeper look. This is recent. And what I mean by recent is we're going back to 1997. From 97 to the tech boom, we were up just over 100%, 106%, went down 49% off the peak, right? Started back up again in 2003. Now, I think that what happened is, first of all, there's two parts to this. First part is the tech boom, so that happened, and that came off. But then the second part of it was 9/11. So I think there was this downturn is kind of caused by two different things. The first thing was the tech boom, then 9/11, and then we needed to recover from all the tragedy and horror of what that was. But we built our way out of it from 2003 back up to 2007. Going up to about another 100%. And then we turn around again and go back down about 57%. Now this is a percentage change, right? So it goes back down about 57% on a percentage change. And then look at this amazing rise since 2007. Okay, if there's one slide that keeps me up a little bit, it's this slide, 265% upwards since 2007. This one makes me think a little bit, there will be a downturn. There will be some sort of other side of the story. Haven't seen it yet. We're looking for it. We're paying attention for it. We expect it, and we're preparing for it in our clients' portfolios. But trees don't grow to the moon, right? Trees eventually come off or break or snap or fall down. There's been usually a 7 to 10 year cycle when things come back down. 2009. We're in that zone of things being, that there should be some sort of correction. We'll see about that. Let's break this down even further. The counterpoint of all this is that when you look at PE, which is a price you pay for the stock for the earnings that it produces, if this is a band, a normal band, and this is a 25-year average in the middle, you can see that we're kind of within a normal range, right? I mean, we're not cheap like it was back in 2009 and 10, and we're certainly not expensive like it was during the tech boom, but we're kind of in the middle, and we're kind of in an acceptable range, and that's pretty good. So that says, okay, valuations haven't gotten silly, and so we're not overly overpaying for stock and for what's happening, particularly for the right stock. So PE ratios are hanging in there to say, well, we can still be interested in the stock market at this point, and we can still do something. And when we dive down a little bit deeper into what actually is happening with different companies, we can look at different parts of this and say, okay, this is kind of interesting. Corporate cash as a percentage of current assets. Companies have money on the sheets. Companies have money to invest. Companies have money to hire more employees. Companies have more money than ever, going back to 2000, and certainly that would only be further back to go, but more. They have a lot of cash. they're returning value to shareholders by returning cash and dividends to shareholders. That's great. Debt, non-financial debt as a percentage of GDP is manageable. It's high, but it's manageable. And overall, fixed M&A activity has been picking up, and corporate growth and fixed investments are growing, meaning the companies are making investments and they're doing long-term fixed investments, and that's been growing. That means that more growth is on the horizon. So overall, this is a very positive picture when we look and we dive a little bit deeper into all this. So we go back to this chart again, and we look at like where the different inflection points are and where things are. And overall, this is the United States, and this is the rest of the world. The United States has definitely recovered. Now, as part of our research organization that we have people come into our office all the time, and all the time people come in from all the great companies out there, all the names that you would know, and people that I've known personally for sometimes 2 to 3 decades, right? Tom, you got to look at international. International hasn't done the same thing the U.S. has. International's next. And I'm like, I see this, I look at this, but I still think that I have more confidence in the United States going further than I do on the international space at this time. I think there's still a lot of turmoil out there. If we do look at international, it's going to be on a very measured level and on a very specific amount. It's not going to be a big dive into the international space for sure. The other thing I want to point out, you see this growth, right? You can see financial crisis growth, financial crisis growth. Maybe a little link. This is the Federal Reserve balance sheet. The Federal Reserve is Janet Yellen's world and the Federal Reserve Board. And what they've done basically since the financial crisis has grown their balance sheet, meaning they've taken on debt. Remember the term quantitative easing, QE1, QE2, QE infinity, all the different things. This has been the expansion of the Fed balance sheet. It is interesting that they jumped in 2008, 2009 and started doing it, which is very similar to the stock market taking off. So one of the things that the Fed has talked about is now lowering the balance sheet. We are paying attention to the idea, because it could be a very real idea, that as the Fed just starts declining their balance sheet, that the stock market could start coming off also. It shouldn't, but there's definitely a somewhat, I wouldn't want to call it exactly a causal relationship, but there is a coincidence at least. So we're going to be paying attention for this coincidence on the other side going forward as well. So the Fed wants to lower the balance sheet. We're going to make sure that that doesn't translate back into what's happening in the stock market for our clients and being aware of that very much. So conclusions. Economic expansion is happening because many important factors in the private economy are doing really well. And they're very positive and things are going well. We went through a number of slides on that. Unemployment is down, and actually at historically low numbers for those people that have an education. 2.4% is a great number. Inflation also is at low levels, so we can, by not spending more for the same thing, we can buy more stuff and more variety of stuff, which is again helping the economy. The Federal Reserve is dedicated to lowering its balance sheet. That ultimately should help in the long run, but in the short term, will that affect the stock market? We're very cautious of this and very aware of this. Residential real estate is near all-time highs again. Pay attention. Now, low interest rates are helping that, and job security and a lot of things are helping that, but we pay attention to that. Consumer confidence is high, and that's almost like a result, right? This plus this equals that, okay? The equal is consumer confidence is high. And the stock market is high for good reasons. Companies have cash on their balance sheets, PE ratios are within that zone we talked about, and technology is helping every company grow. Ultimately, we can look at all these things, but the bottom line is, life is good because God is good. And I do wholeheartedly believe that. So I hope that this few minute demonstration has been able to show you what I'm thinking about in the fourth quarter, how I'm looking forward to repositioning portfolios. There's going to be a lot of repositioning going on. We've had some great winners. We've got some things we've got to adjust and some different things. I do make available, of course, if you're not a client, a free 1-hour consultation. Go through your stuff, hear about what your situation is, how we might be of service, how we can serve you. If we are a client, man, I love talking to you. Anytime I can be of service to you, it is my heart to jump in there and do anything I can to serve you. And so I'm very happy to be able to spend some time with you today. Thank you very much for your time. If you want to reach us, you can reach us at dubinvestments.com, Dub Investments with plural, or 949-276-5800. Look forward to speaking with you, sharing some time, and doing any way I can to serve you. Thank you so much.